हेलो एवरीवन, आप सभी का फिर से एक बार स्वागत है मेरे यूट्यूब चैनल में जिसका नाम है कॉमर्स ट्रेजर। इन दिस वीडियो वी आर गोइंग टू डिस्कस अबाउट KUD MCOM फर्स्ट सेमेस्टर फाइनेंशियल मैनेजमेंट 2019 क्वेश्चन पेपर 2 marks question. I've already made video on 2021 papers 2 marks questions. If you have not seen that video, I'm putting the link into the description as well as in the I button. Do watch those videos. And without wasting much time, let us go to the 10 questions of 2019 paper. The first question is define financial management. So I have given a list of 2 definitions as well as a general meaning of financial management. Let us see. According to Solomon, financial management aims to effectively use the capital funds, which also happens to be significant economic resources. So financial management is nothing but whenever you make use of the funds, that is money, capital, effectively, because these are scarce resources which are also economic resources. So this is what is called as financial management. And one more definition, according to Philippetus, financial management is concerned with managerial decision that results in acquisition and financing of short and long-term credits for the organization. So according to him, it is a managerial decision which aims at what? Acquisition, that is borrowing and financing of short as well as long-term credits for an organization. Now the general meaning of financial management says that financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying the general management principles to financial resources of the enterprises. So very simple, it is nothing but performing of all the management activities, that is planning, organizing, directing and controlling of what? Of the financial activities, which includes 2 major functions. One is you have to procure, you have to get, and second is you have to use, you have to make utilization of that funds which you have procured. The second question is, what is financial leverage? Financial leverage is defined as an ability of a firm to use fixed financial charges to magnify the effect of change in EBIT on change in EPS. So financial leverage is nothing but it establishes a relationship between EBIT and EBT, or you can say it established a relationship between EBIT and EPS, that is earnings per share. Now financial leverage occurs because of some financial fixed costs which are there in your capital structure. It may include cost of interest on debentures. Financial leverage involves the use of funds obtained at fixed cost in the hope of increasing the returns to the shareholders. So these are the 2 meaning of financial leverage. So the formula for financial leverage is as follows: EBIT divided by EBT, that is earnings before interest and tax divided by earnings before tax. Operating leverage can be found out using the formula contribution divided by EBIT. So contribution you can find out by using the formula sales minus variable cost. So from contribution, if you deduct fixed cost, you get EBIT, and combined leverage is nothing but financial leverage into operating leverage, or what you can do, you can just write contribution divided by EBT. So these are the 2 ways in which you can compute the combined leverage. The next question is, what do you mean by optimum capital structure? So optimum capital structure can be defined as a capital structure or combination of debt and equity that leads to maximum value of the firm. So optimum capital structure is nothing but it is a structure or it is a mixture of debt, that is debentures, and equity share capital in such a proportion that the returns from that is maximum. It is the capital structure at which the weighted average cost of capital, that is nothing but overall cost of capital or KO, is minimum and value of the firm is maximum. Capital structure at whatever mix of debt and equity the KO, overall cost of capital, becomes least and the value of the firm becomes maximum, that is called as optimum capital structure. The next question is, state any merits of stable dividend policy. So first we must understand what is this stable dividend policy. Stable dividend policy is nothing but it is a policy where shareholders receive a certain minimum amount of regular dividend on a scheduled basis, but the amount of rate is not fixed. Investors that are risk averse and income oriented typically prefer this policy and consider it a safe bet even if the company pays lower dividend. So stable dividend policy is nothing but, in any company if they are giving regular dividends, then it is called as stable dividend policy. The dividend may not be very high, it may not be very low, but it is going to be a stable. Every year they pay a certain amount of dividend, then it is called as stable dividend policy. Now let us go to the merits of this type of policy. The first merit is it creates confidence among the investors. The investor can be assured that every year he is going to get certain amount of dividend. Second, it provides a source of livelihood to those investors who view dividend as a source of funds to meet day-to-day expenses. So if there are some investors who are investing in stock markets because they want regular income, then this policy is going to be a good source for them. Third one, it is accepted by the shareholders because shareholders are investing in the company and they are expecting dividends. If you are giving regular dividends, then definitely it is accepted by the shareholders. And the fourth merit is it helps to raise additional funds easily, because you are paying dividend regularly. The investor, as they have more confidence on you, then you can raise additional funds easily. Even the institutional investors like LIC, IDBI, IFCI, all these institutions, they invest in companies which pay regular dividends. The next question is, what is capital rationing? Now capital rationing is a financial situation in which a firm has only a fixed amount to allocate among the competing capital expenditures. So in simple words, capital rationing is a situation where you have limited funds, right? You have very limited amount of funds, but you have many proposals or many projects in which you can invest. So at that time, based on the benefits, what you do, you allot or you divide your funds, which is called as capital rationing. Now simple example for this is, you all might get some pocket money. Think that if you get 100 rupees pocket money and you have a lot of different plans. One plan might be going out and eating pani puri, one more plan might be doing a recharge to your mobile, another plan might be having a chocolate. Then which of the following are you going to do first? That is called as capital rationing. So from that 100 rupees, you can first go and have a chocolate, then you might left with 70 or 80 rupees. If you can go to a movie in that remained amount, then you have to select the second option, and this is how capital rationing works. It refers to a situation in which a firm has more acceptable investment than it can finance. In such a case, the firm uses capital rationing technique to accept or reject the group of investment proposal out of many investment proposals. So as we discussed, you might be having a lot of alternatives, but you cannot select all because of limited funds. The next question is, what are the demerits of payback period? Now payback period is a capital budgeting tool, so it has some drawbacks. Let us see the drawbacks of payback period. The first drawback is it ignores all the cash inflows after the payback period. So if you calculate payback period and you get the full initial investment after maybe 3 years in a 5-year project, in such a case the revenue or the cash flow in the 4th and 5th year is going to be ignored in this technique. Second, it ignores time value of money. It does not consider time value of money, and because of this, an upgraded version of this technique, discounted payback period, was developed. The third is it does not take into consideration the entire life of the project. So as I said, it considers only the time till which the initial investment is recovered. So after that, it does not consider. And fourth point is it does not consider the project return on investment. So it only considers in how many years you will get your initial investment back, but what is the rate of return, how much you are earning on that project, this is not computed in payback period. The formula for payback period is initial investment. So whatever initial investment you have done in that project divided by cash flow per year. So whatever cash inflow you are getting per year, if you divide by this, you get payback period. Next question is distinguish between permanent and temporary working capital. So permanent working capital refers to a level of current asset that have to be maintained regardless of the level of business operations, whereas temporary working capital refers to the working capital which is over and above the permanent working capital. So the minimum amount which you required, that is called as permanent working capital, which is usually fixed, and above that whatever additional you require depending upon the demand, that is called as temporary working capital. The second point is permanent working capital is financed through long-term funds because they are always needed, whereas temporary working capital is financed through short-term funds because these are seasonal and are fluctuating in nature. The third point is permanent working capital is stable, whereas temporary working capital is very fluctuating. It changes, as I said, depending upon the market conditions. The last point is permanent working capital have regular funds for everyday work, whereas temporary working capital have temporary funds or seasonal requirements. The next question is state the reason for rejecting profit maximization objective in financial management. So financial management has two objectives. One is profit maximization objective, which has a lot of demerits, and because of which the next objective or the main objective now has become wealth maximization. So let us see the reasons for rejecting profit maximization objective. So first reason or first demerit you can say of profit maximization is it ignores time value of money. It does not consider the time value of money, which is very important when we apply the financial management techniques. The second is the term profit is vague and ambiguous concept. So they say profit maximization is a concept where profit should be maximized, but which type of profit are they speaking is not clearly defined, whether it is net profit, whether it is gross profit, whether it is operating profit, whether it is profit before tax, profit after tax. So this is very vague and ambiguous. Third one is it ignores the quality of benefit, that is the certainty is not known. You just know that there is going to be benefit, but to what extent, this is not given in profit maximization. Fourth, it ignores risk. So risk is not considered in case of profit maximization, which is a biggest demerit of profit maximization. And last one is profit maximization can bring extra money only in short term but not in long term. So profit maximization is criticized because it is a short term concept but not a long term concept. So in a short term you may earn profit, your company may survive, but for a long term wealth maximization becomes very important. The next question is a repeated question. What is arbitrage process? So as we know, arbitrage is nothing but it is an act of buying securities, commodities or currencies from one market where price is less and selling the same into another market where prices are high. So if you are doing arbitrage of currency, then it is for multinational financial management subject or foreign exchange management. If you are doing it for commodities, then we talk about security analysis or we talk about general arbitrage, and when we talk about capital structure, it becomes arbitrage in financial management. So here we are more concerned with capital structure arbitrage. Let us see what is this capital structure arbitrage. So capital structure arbitrage is an arbitrage in which investors switches from overvalued firm to the undervalued firm and thereby earning a profit called as arbitrage profit with the help of homemade leverage as per the approach. So you just jump from a firm which is overvalued to a firm which is undervalued, and thereby what you do, you earn profit which is called as arbitrage profit. This continues till the firm reaches its right valuation or reaches the equilibrium. The last question for this paper is state the formula for calculating work in progress holding period. So the formula for calculating work in progress holding period is nothing but 360. Usually we make use of 360 days. It depends upon the question. If they give 365, you can also take 365 days into stock of work in progress. So whatever there is stock of work in progress, you have to write divided by cost of goods sold or cost of goods manufactured, whatever is given in the question. So this is what you have to remember as formula for calculating of work in progress holding period. So this concludes the 10 questions. If you have any doubts, you can comment me in the comment box. If you like the video, please hit the like button, and if you haven't subscribed my channel, please subscribe my channel and also press the bell icon. Thank you for watching this video and share this video with your friends.